Hey there, future Wall Street titans. Jim Cramer here, ready to break down the exciting but often misunderstood world of futures and options trading. Now, these financial instruments might sound intimidating, but trust me, once you grasp the basics, you'll be speaking the language of the markets in no time. Futures and options are basically contracts that give you the right to buy or sell an asset, like a commodity or a stock, at a specific price on a future date. Think of it like placing a bet on the future price of something. You're essentially saying, I think this thing is going to be worth more or less in the future, so I'm locking in this price today. Futures are like a binding promise. You have to buy or sell at the agreed-upon price when the contract expires. Options, on the other hand, give you the option to buy or sell, but you're not obligated. It's like having a rain check for your investments. Now, before you jump headfirst into this fast-paced world, let me tell you, it's not all sunshine and rainbows. There are risks, misconceptions, and emotional pitfalls that can trip up even the savviest investors. But don't worry, your favorite financial guru is here to guide you through it all. So buckle up, grab your thinking caps, and get ready to dive into the thrilling world of futures and options trading. Alright, let's clear the air and bust some myths about futures and options trading. You see, there's a lot of misinformation floating around out there, and the last thing you want is to fall for some get-rich-quick scheme. Myth number 1, futures and options are only for high rollers and Wall Street hotshots. Wrong. While it's true that these instruments can involve significant sums, you don't need a trust fund to get started. There are contracts available for all budgets. Myth number 2, it's easy money, if only it were that simple. Futures and options trading require knowledge, strategy, and a good dose of risk management. Don't believe the hype about overnight riches. Myth number 3, you need to be a math whiz to succeed. Sure, understanding the numbers is important, but it's not about complex equations. It's about grasping basic concepts and using your analytical skills to make informed decisions. Remember, trading is a marathon, not a sprint. It takes time, dedication, and a willingness to learn from your mistakes. So, ditch the myths and approach trading with a realistic mindset. Now let's talk about the elephant in the room: risk. Futures and options trading involve a significant amount of risk, and it's crucial to understand this before you even think about placing a trade. One of the biggest risks is leverage. Leverage allows you to control a large position with a relatively small amount of capital. While this can amplify your gains, it can also magnify your losses, potentially leading to significant financial setbacks. Another risk is market volatility. Futures and options markets can be incredibly volatile, with prices swinging wildly in short periods. This unpredictability can catch traders off guard, resulting in unexpected losses. And let's not forget about the time decay of options. Options have an expiration date, and as that date approaches, their value erodes. This means that if the market doesn't move in your favor, you could lose your entire investment. The bottom line is this: never invest more than you can afford to lose. Start small, manage your risk carefully, and always have an exit strategy in place. Section 4. The emotional roller coaster: how feelings can wreck your trades. Hold on tight, because futures and options trading can be an emotional roller coaster. One minute you're riding high on a winning streak, the next you're staring at a sea of red. And let me tell you, emotions in trading are about as compatible as oil and water. Fear, greed, hope, and despair. These emotions can cloud your judgment and lead to impulsive decisions that can sabotage your trading success. Fear can make you sell too early, missing out on potential profits, while greed can make you hold on too long, turning a winning trade into a losing one. One of the biggest mistakes traders make is letting their emotions dictate their actions. They get caught up in the heat of the moment, abandoning their trading plans and making rash decisions based on gut feeling rather than logic and analysis. The key to emotional control in trading is to have a solid plan, stick to it, and don't let your feelings get the best of you. Remember, discipline and emotional intelligence are just as important as any technical indicator or trading strategy. Section 5. Rookie mistakes: steer clear of these trading traps. Listen up, rookies. The world of futures and options trading can be a minefield of mistakes, especially for those just starting. But don't worry, your pal Jim Cramer is here to steer you clear of some common pitfalls. Mistake number 1. Jumping in head. Trading without understanding the basics is like trying to fly a plane without taking lessons. A recipe for disaster. Take the time to learn the ropes, understand the risks, and develop a Mistake number 2, overtrading. It's easy to get caught up in the excitement of the markets and want to trade every little move. But remember, patience is a virtue. Wait for high probability setups. Market fluctuation. Mistake number 3, ignoring risk management. Never underestimate the importance of risk management. Always use stop-loss orders to limit your potential losses and never risk more than you can afford. Trading is a marathon, not a sprint. Start small, learn from your mistakes, and don't be afraid to seek guidance from experienced traders.